feel like I might have to bring back the VAR series, honestly, because hey, there's a lot of content that I've been missing out on. There's a lot of content that we could debunk out here.
If you own a corporation in Canada, you're probably getting robbed by the tax system and you might not even know it.
Damn,
Let's say your corporation earns
I'm not even gonna lie, that's a fire hook. His hook game is way better than mine. That's a fire hook.
$500,000 in active income. You're probably thinking, sweet, I'll only pay 12% tax. But here's what you probably don't know, and what they definitely don't tell you, is that if you have more than $50,000 in passive income from stocks, bonds, rent, or even GICs, your small business tax rate gets clawed back. That 12% will eventually jump up to 27%.
So this is true. Like whenever we talk about people having corporations, like whenever if a creator is making a certain amount of money, or if a digital business owner is making a certain amount of money, say they're making over 70K, people usually recommend, although it varies case by case basis, to get a corporation. And the reason being, they're running a business, so they are earning active business income, which means that they would fall into the 12% threshold that this gentleman is referring to. In no way, shape, or form should they be investing a lot in that corporation. That corporation is an operating corporation. It is meant to earn money. If you're a creator, that corporation is meant for you to create content, generate income through brand deals, generate income through ad revenue, and that's it. Not have any investments in it, no real estate, no stocks, no bonds, no GICs, right? So let's make that clear, because if you ever have investments or passive income within that operating company, it loses its small business rate, as he is correct, and it jumps up to 27%. And sometimes with investments, you can become classified as a specified investment business, and your corporation can be taxed as high as 50%. So to go even further to what he's saying, it's that bad, right? It's not even 27%. It could go even higher. So I think that's clear. I think, for anyone who is running a business and has a corporation, make sure that it is running as an active business, as it was when you set it up. Don't try to get investments within that corporation. What you will do is set up a holdco that will own that opco, and that way you can issue yourself tax-free dividends between, carry over cash from one corporation to another. You get liability benefits, which means if someone sues your opco, they will not sue. They will not be able to have access to your holdco, and that's where you can hold assets, right? And to go even further, you want to have the holdco have the opco, but also have a lot of like corporations for investments, right? Like if you want to have real estate, that should have its own corporation. Maybe if you want to have a different type of investment, maybe that should have its own corporation. Always trying to split up. Always try and aim to split up that liability. He mentioned something that's kind of like a fear, right? Like if you're someone who has a corporation and you hear that hook, i.e. myself, like I know this stuff, and I was still like, huh, what? I was like, did I miss something? But no, let's be clear here. If you have a corporation and you're trying to take advantage of the low corporate tax rate, ensure that you remain in business activity, in proper operational business activity, and not passive income. All right, let's keep going.
So now you're a little bit stuck. You've got all this retained earnings sitting inside your corporation, but how do you actually put that money to use? Well, you could pay yourself a salary, and if you do, that could be up to 53% in your personal tax rate.
Correct, but the corporation allows you to not, because you control your salary. So why would you pay yourself a salary that's over 250K to get into that 53% bracket, right? Like that could happen. That's literally like the worst case scenario, right? That's like me going to judo class thinking, okay, like I'm gonna get hurt today. Like I have the power not to get hurt, right? I could cushion someone's fall after a throw. They could cushion me and hold my arm after a throw. But you know what? I'm gonna just make sure I get hurt today. Like no, it's a worst case scenario, but it's not like you have the power to not do that, right? So with the corporation, you pay yourself a combination of salaries and dividends to ensure that you do not end up in that high tax bracket of 53%.
Percent tax. Or maybe you want to pass it along to your kids when you die. Well, now there's going to be a capital gains tax and a dividend tax. That's
The best way to do that would be by disposing of it, right? So that you can take advantage of the lifetime capital gains exemption, which depending on how big your business is, and how valuable it is, it may not be sufficient. Like a lifetime capital gains exemption is in the millions. And if that is not sufficient, maybe you set up a structure where You have a trust owning that corporation, and then now if the beneficiaries of the trust are your family members, then that lifetime capital gains exemption gets to be applied for each of those members, which then probably should cover the entire capital gains of your corporation. So yes, if we're talking about Canada, you can pass this on. You can pass your corporation on to your kids without suffering from capital gains tax. And if we're talking about the U.S., it's even better because there's step up in basis when you die. So your corporation's value, the fair market value, becomes the adjusted cost base. And if your kids inherit that, they're not paying tax on that, right? So this is step up in basis is a concept in the U.S. He's Canadian, I believe he's from Vancouver or BC. So I think he was referring to like, hey, like this is, we don't have that U.S. concept, so you'll pay tax on it. But no, the lifetime capital gains exemption is meant for something like this. And there's a lot of estate planning tactics that you could do, like an estate freeze to mitigate this, right? So again, corporations ain't so bad, all right? They aren't so bad, all right? We're getting somewhere here. There's a lot of shadows painted around it right now through this video. We're at 56 seconds, and we're just putting a flashlight on that. We're just zooming in on it. You feel me?
Double taxation at death. So you could end up paying over 70 cents on the dollar in total taxes just to use that money that you've already earned. The CRA loves it when you take money out of your corporation in the traditional way, but wealthy people, they play the game completely different. And in part 2, I'll show you how they escape this trap using a holding company and a tax-sheltered asset that compounds at 5% a year with no passive income penalties.
I like that. I like that he mentioned the holdco. So he's a smart guy. You know what I'm saying? Like he is giving you a solution. I don't know where he's going with that tax asset that yields 5%. I can sniff it. I have an idea what it'll be, but I'm not sure. Before we find part 2, I want you to put in the comments down below. Let's gamify this a little bit because I'm feeling nice. I'm having fun. Let me know what you think that taxable asset is going to be. I would love to know. I would love to have 5% on a dollar. That's a tax-free asset. Like I can withdraw it tax-free, and the CRA does not want me to know about this. Come on now, like I need to lock in. Like clearly there's something I don't know, and if I don't know and y'all don't know it, we gonna figure it out together. So let's go ahead and find part 2, y'all. All right, y'all. I think we got it. Here's part 2.
Passive income inside your corporation can destroy your small business tax rate.
That's facts.
But there's a legal workaround. This is part 2. In part 1, I showed you how pulling cash from your corporation can lead to brutal taxes, up to 70% at death when you have double taxation of capital gains and dividends. But here's how the wealthy structure around it. Instead of taking money personally, they move their retained earnings from their operating company, or OpCo, to their holding company, or HoldCo.
This is good advice. This is true. Like your retained earnings, so money that you haven't paid yourself through salaries or dividends. So this actually debunks his statement about how you don't want to pay yourself a salary and pay 53% tax, because no one would actually do that, right? They would pay themselves a salary that's reasonable compensation, also kind of like a U.S. term, or like you pay yourself the right amount, so that you're in an okay tax bracket, right? Usually you'll see people pay themselves a salary between 50K to 80K, but it really depends on your operating expenses. And when you are the owner of your corporation, you choose how much you pay yourself, right? So you have that flexibility to not put yourself in this situation where you're paying 53% tax. So I'm glad he's talking about this. Like the holdco, yes, it's facts. That's what most people do. So there's no need to fear about that.
Inside the HoldCo, they buy a participating whole life insurance policy.
There it is. I smelled something. Yeah, let's keep going, man. I don't want to infer too much. Let's keep going.
Why? Well, it's because the growth inside the policy is sheltered of tax, and
that's true. I'm impartial. That is true. If you get a life insurance policy, your cash value grows in it. It is not going to be taxed as it grows. It is indeed sheltered. I wouldn't call it a tax deferred tool. Like a tax deferred tool is something where without it, you would be paying more tax in the present, but you're not. And whole life insurance doesn't do that, right? Whole life insurance, you're earning 100K and you decide to contribute like 20K into your policy, you're still paying tax on 100K. So it is not a tax deferring tool. It's a tax saving tool, or if anything, it's an estate planning tool. That's the best way I like to call it. But it's not a tax saving tool or a tax deferred tool.
It doesn't trigger passive income rules. That means no small business tax clawback, no passive income grind. It just compounds steadily at around 5% per year, again, shelter to tax. And the best part is eventually at death, the death benefit can be pulled out of the corporation completely tax-free. Now,
That's true. One thing, and this is gonna be the nail in the coffin for a lot of these videos. No, hold on. I need the full can for this one. So what I'm about to say is the part where the referee goes to the screen, right? Like he's like the assistant referees are on his line being like, hey, you got to go review this like it's a handball. And the referee goes there and views it and comes back on the pitch. This is what I'm about to say. This is the statement right here. A lot of, wealth advisors, I believe the gentleman is a wealth advisor. And kudos to him. Like his content is amazing. Like the hook at the beginning, that got me. For a second, I was like, hold on, wait, maybe corporations are not a good thing. Maybe it's like the CRA does not want me to know this. So like I was tapped in from the jump. But alas, while you were paying for that whole life policy, the premiums were not tax deductible. So yes, you were paying with pre-tax income, which is a benefit of it. Like that's one thing that I wish like people would actually argue that and say that, because that's the truth. Like you're getting to pay insurance premiums with pre-tax income, not with after-tax income. It's like pre-tax income. It's not a deduction, you know what I'm saying? But like you're able to say, like from a cash flow perspective, you're able to make those payments before Uncle Sam and Auntie Sarah get to come in and collect something. You know what I'm saying? So there is that benefit. But in terms of, what it has to offer and how it's portrayed at this like tax saving tool, it's not what it's meant to be, all right? Like corporate life insurance is great. Again, I'm not trying to shit on it. Corporate life insurance is great if you are looking for proper estate planning, if you want to leave your kids with money to cover certain expenses and to keep them pushing and grow generational wealth, great. If you want to get let's use a proper valid corporate life insurance example, right? So like we can see how like why these are intended and why these are actually useful. Say you run a corporation. It could be, a CCPC in Canada, S Corp, C Corp in the States, right? You have a couple directors who are very, very key. I'm talking about like they know the business in and out. They're essential to this business. And if they were to go away, this business might crumble. It might just crumble, right? Enter life insurance policies. Because now with these life insurance policies, say these individuals, these very key individuals were to move away, unfortunately, now the corporation has enough cash to cover share buybacks, right? Because think of it, if like a shareholder, if a key personnel passes away, you want to retain control of the corporation. You want the corporation to remain in the hands of people who can do the work and people who are heavily invested in the corporation. So it may involve having to buy shares. It may have to involve having control of equity, which includes cash outflows. And that life insurance policy allows for that, right? So that's a proper example of actually using corporate life insurance. Those are real life scenarios that people actually go through, replacing key personnel, right? And in no way, shape, or form is tax mentioned. And that's why whole life insurance and life insurance policies, if they're used in the present, as in like tax benefits of payouts are not considered, they're usually used for a strategic purpose, which is either to preserve something, which is the whole point of what insurance is, preservation at the core. Or two, they are meant to be able to be used as a cash flow tool, right? I'm able to make my premiums pre-tax before Uncle Sam or Uncle Sarah gets to me. I am able to, if from the cash value that I've invested, if the banks are trying to give me like a 10% interest rate or something because my business is a risky one or something like that, I have my own life insurance cash policy that I could pull out from. And this is not a withdrawal. Let's be clear. It's not a withdrawal. It is a loan. You are loaning to yourself. You have to pay that money back to your insurance policy. Yes, it's your money, but it no longer is your money because it is now in the hands of whoever is running the life insurance policy, and they want their money back. They want your money back. So yeah, I mean, like this gentleman, he had some good points, like, but overall, it's a video that stuck out to me. I wanted to react to it with you guys. Let me know what you guys' thoughts are on like other good uses of corporate life insurance, because it is a useful tool. It is a useful tool. It's a shame that on social media it's not portrayed that way. I feel like there's a couple reasons why, but it just gives it a bad name. And I know some really good, insurance agents, people who are, insurance agents, and they will tell you like how these policies are supposed to work. Let me know what you guys think about this. Like, would you guys have life insurance? Like, would you guys ever get life insurance? Do you guys see, do you guys know of any other benefits to life insurance? Let me know in the comments down below, man. Let's have a healthy discussion about financial literacy. Let's have a healthy conversation about proper tax strategies. Thank y'all for watching. I'm going to see y'all in the next video.